Hello everyone, I am Reynelin B. Manamdam and I'll be tackling about different forms of business ownerships. So we have our objectives for this discussion. At the end of this discussion, we shall be able to define the different types of business ownerships and also to determine the advantages and disadvantages of each type of business ownership. There are four major types of business ownerships. Those are the sole proprietorship, partnership, corporations, and the cooperative. Our discussion will focus on these four types and I'll be giving you a brief explanation of each type. The first form of business ownership is the sole proprietorship. A sole proprietorship is an unincorporated business entity that is owned by a single person. There is no separate business entity, meaning there is no distinction between the business owner's personal and professional assets and liabilities. Sole proprietorships are simple, easy to start, and one of the most common types of business ownership. They are a good option for someone starting a low-risk business on a trial basis. It is the simplest type of business structure and not a legal entity. That's why there is no formal filing needed. Additionally, profits earned are taxed as personal income and delineated on your tax return. So the business doesn't pay any special federal and state income taxes. Under sole proprietorship, we had its pros or its advantages. First is that it is free or low cost. Sole proprietorships are inexpensive and easy to form. As long as you're the owner and in charge of operations, there's no need to formally register your business or notify federal or state offices. The only fees involved are those needed to register your business name and to attain the appropriate licenses and permits. Second is that it is easy to maintain. Sole proprietors keep proper records, files, and pay taxes on the business income and other personal income sources. Record keeping and tax filing obligations are generally no more complicated than maintaining records for individual tax filings. Third and last is the owner control. In sole proprietorship, as the owner, you have the complete control over your business. You make all important decisions and are generally responsible for all day-to-day activities. There is no need to make decisions based on the wants of shareholders or the requirements of legal partners. You can pivot your strategy as needed and take your startup in any direction you wish to grow. In exchange for assuming all this responsibility, you get all the income earned by the business. For many people, however, the sole proprietorship is not suitable. The flip side of enjoying complete control is having to supply all the different talents that may be necessary to make the business a success. And when you're gone, the business is also dissolved. Even more important is that the sole proprietor bears unlimited liability for any losses incurred by the business. So here are the cons or the disadvantages of sole proprietorship. First is that it has unlimited liability. The principle of unlimited personal liability means that if the business incurs a debt or suffers a catastrophe, say getting sued for someone causing an injury to someone, the owner is personally liable. As a sole proprietor, you put your personal assets, your bank account, your car, maybe even your home at risk for the sake of your business. Second is that it has no tax benefit. Because sole proprietorships are linked to the owner as an individual, all taxes are considered a pass-through entity. This means that you must declare any income or losses accrued by the business on your personal tax return. And you also have to pay self-employment taxes to cover your contributions to Social Security and PhilHealth. Third is that it has difficulty in raising capital. In sole proprietorship, you have to rely on your own resources for financing. In effect, you are the business and any money borrowed by the business is loaned to you personally. Under this structure, banks can be hesitant to lend money or issue credit as the company is not formally recognized. The second form of business ownership is the partnership. A partnership is a form of business where two or more people share ownership as well as the responsibility for managing the company and the income or losses the company generates. These are formed when two or more persons agree to place their money, effects, labor, and skills in a lawful commerce or business, with the understanding that there shall be a proportionate sharing of the profits and losses among them. In a broad sense, a partnership can be any endeavor undertaken jointly by multiple parties. These parties may be the government, non-profit enterprises, businesses, or private individuals. The goal of partnership also varies widely. There are several types of it. They can be classified as to liability, as to contribution, and others. So within the narrow sense of a for-profit venture undertaken by two or more individuals, we have two main categories of partnership. These are the general partnership and the limited partnership. The first category of partnership is the general partnership, where partners agree to be personally responsible for the potentially unlimited liability. So here are its advantages or pros. First is that it is less expensive than forming an entity with the state. This is easier to organize since it can be formed by the mere agreement of the partners and does not entail a high cost of permission. Second is that it requires little paperwork. General partnerships are usually less expensive to form and requires less paperwork and formalities than corporations, limited partnerships, or limited liability partnerships. Additionally, there is a pass-through tax treatment. Filing is relatively easy. There is no taxation to the business itself. All income, deductions, and credits pass through to the individual partners and are reported on their individual tax returns. Lastly is that it pools talent. Partners can combine resources and share the financial commitment, and as well as the skills. So under its cons or its disadvantages, we have the unlimited liability. They can be held liable even to the extent of their separate assets. They are personally liable for the business debts and liabilities. Each partner is also liable to the debts incurred by the actions of other partners, which are quite similar to the unlimited liability discussed under sole proprietorship. Lastly is that it has no tax benefits since the tax will will be passed through to the individual partners. So, next is the limited partnership. It is a partnership structure that reduces each partner's liability to what they have contributed. So, we had its pros or its advantages. First is that it limits liability. Limited partners have no liability for partnership obligations beyond their capital contributions, protecting them against personal liability for the partnership's debts and other obligations. They do, however, receive a share of the profits for their involvement as limited partners. Next is that the pass-through taxes. A limited partnership also enjoys the advantage of pass-through tax treatment, as it is taxed like a general partnership in that it is the profits and losses passed through the partners who can include their allocated income on their personal tax returns. Next is the cons or the disadvantages. First is that management duties equally divided. The limited partners simply invest in the business and have little control over the business operations. Lastly is more costly than a general partnership. Limited partnership also have a more filing formalities than a typical general partnership. The third form of business ownership is the corporation. A corporation is a legal entity organized under state laws whose investors purchase shares of stock as evidence of ownership in it. A corporation is legally a separate and distinct entity from its owners. It possesses many of the same legal rights and responsibilities as individuals. Additionally, a corporation may be created by an individual or a group of people who share the same goal, and that does not always involve making profit. Under corporation, we have different types. First is the private corporation. A private corporation has a small group of investors who are unable to sell their shares to the general public. Second is the public corporation, where it has registered its shares for sale with the Securities and Exchange Commission or SEC, and may also have listed its shares on a stock exchange, where they can be traded by the general public. Third type is the professional corporation. A professional corporation is a variation of the corporate form available to entrepreneurs who provide professional services. An example of this are the lawyers, doctors, accountants, consultants, and architects. Next is we have the S corporation. An S corporation are corporations that elect to pass corporate income, losses, and deductions and credits through to their shareholders for federal tax purposes. Next is the C corporation. A C corporation or C corp is a legal structure for a corporation in which the owners or shareholders are taxed separately from the entity. So this is different from the S corporation. And lastly, the non-profit corporation. A non-profit corporation is an organization formed to serve the public good, such as for charitable, religious, educational, or other public service reasons, rather than purely for the creation of profit itself as the businesses aims to do. The biggest benefit of choosing this form of legal entity is that it is exempt from paying federal and state taxes on any income the corporation earns. So, under corporation, we have its pros or its advantages. First is the limited liability. The shareholders of a corporation are only liable up to the amount of their investments. The corporate entity shields them from any further liability, so their personal assets are protected. This is a particular advantage when a business routinely takes on large risks for which it could be held liable. Next is the source of capital. A publicly held corporation, in particular, can raise substantial amounts by selling shares or issuing bonds. This is a particular advantage when its shares trade on a stock exchange, where it is easier to buy and sell shares. Third is the ownership transfers. It is not especially difficult for a shareholder to sell shares in a corporation, though this is more difficult when the entity is privately held. Fourth is the perpetual life. It means that there is no limit to the life of a corporation, since ownership of it can pass through many generations of investors. Lastly is the pass-through. As mentioned earlier, if the corporation is structured as an S corporation, profits and losses are passed through to the shareholders, so that the corporation does not pay income taxes. So if we have the pros or the advantages, we also have the disadvantages or the cons. First is the double taxation. Depending on the type of corporation, it may pay taxes on its income, after which shareholders pay taxes on any dividends received. So income can be taxed twice. Second is the excessive tax filings. Depending on the kind of corporation, the various types of income and other taxes that must be paid can require a substantial amount of paperwork. The exception to this scenario is the S corporation, as noted earlier, that it has a pass-through tax treatment. Lastly is the independent management. If there are many investors having no clear majority interest, the management team of a corporation can operate the business without any real oversight from the owners. So the last form of business ownership is the cooperative. A cooperative is a legal business structure that is owned and governed by and functions for the benefit of those who use its services. Cooperatives are owned by those who work for it, are served by it, or both. Co-ops are made up of customers, providers, or both, in order to fulfill a common economic, social, and cultural necessity or an objective in markets that are unattractive to other businesses. The members are all owners and managers in the business, and they are sometimes called as user owners. So, under cooperative, we have three different types: the consumer co-op, the producer co-op, and the hybrid co-op. First is the consumer co-op. It is one where the members combine their purchasing power to receive discounts on goods or services. The cost savings is usually realized from purchasing directly from suppliers, thus eliminating middleman fees and markups. They may be owned by consumers, producers, or workers, but in any case, the ones that purchase the final goods or services own the co-op. Second is the producer co-op, which is normally owned by small businesses, partners, or other suppliers of goods and services. This allows the members to obtain less expensive supplies necessary for production, lower rates on credit, and cheaper prices on equipment. This can aid in providing economies of scale, which can offset production costs and make them more competitive with large corporations in the industry. These cooperatives are owned by those that produce final goods or services. Lastly is the hybrid cooperative, which is a combination of both producer and consumer co-ops. This type is owned by both the employees and customers. Customers form a large enough group to assure enough demand for the workers to produce high enough volumes to reduce production costs by aligning together for group discounts on credits, supplies, and equipment. It is the aggregate of both other types of cooperative business, united in similar goals. So, for the pros or the advantages of cooperative, we have the less tax. Similar to a limited liability company, members are only taxed on income received. There is no corporate or other type of double taxation. Second is the unique funding opportunities. There are often government grant programs designed to assist cooperative startups. Third is the reduced cost of operations. Since co-ops tend to be large, they can typically negotiate lower prices on the larger purchases. Fourth is the survivorship. Co-ops can continue on in perpetuity, much like a corporation. Lastly is the democratically organized structure. Since each member gets a single vote regardless of their contribution, it can be assured that it will be served the needs of all members. Next, under its cons or its disadvantages, we have two. First is the reduced capital acquisition. Co-ops cannot seek outside investors and member contributions are often limited to the utility each receives from the association. Second is that it has lack of participation. If members do not contribute adequately to the co-op's needs and objectives, it could lead to reduced membership and possible failure of the cooperative.
So that would be all for my discussion. Hope you all get something out of it. Also, if you have any questions, feel free to raise it. And that would be all. Thank you.